Welcome to Roaming Returns, a podcast about generating a passive income through investing so that you don't have to wait till retirement to live your passions. If you're in the process of building your portfolio, this is the episode for you. Tim outlines what he considers to be the best evergreen stocks for everyone to start investing. Yes, prices vary, but if you wait to pick up shares when a stock's PE is below its peers, you'll hedge in a margin of safety. So start with the first sector and work your way down. Welcome back, guys.
Oh, are we live? Hello.
As promised, we're back with the best stocks to buy right now.
Well, she has it worded that way, but I think like if you're just starting out in an income investing portfolio, these are my recommendations to start with and then branch out once you have a pretty good position in these. The tricky part when it comes to funding a income portfolio is got to find undervalued investments across a few sectors. The sectors that I like for income investing would be REITs, obviously, BDCs, obviously, utility, bonds, energy, technology, and consumer staple, which I guess is just like an all-encompassing thing that what people use, like toilet paper and shaving cream and things in that nature. But we'll start with technology, because technology has been like one of the hottest sectors for aeons. It seems like forever.
I was going to ask you, why'd you pick those sectors?
Well, because it's what generates the most income.
Okay.
You're trying, like I just said, like you have to find undervalued investments, and the ones that keep popping up are like utilities and bonds because they've been and BDCs and REITs because they've been getting their ass kicked because of interest rates.
You just said bonds? Bonds isn't on there, is it?
Yeah, the bond sector.
Oh, I'm tarded.
You are.
I obviously wasn't paying attention. I tune you out when you speak.
You do. Now, with technology, what I do, I differentiate than most investors with tech. Tech, I like funds. Closed-ended funds is what I like, or ETFs. I don't do individual stocks because individual stocks are difficult. You don't know which one's going to take off, and then even if you are able to find one, majority of the time it's going to be a growth stock. You're not going to get a dividend from it.
Yep. Because we're a different kind of investor than the people chasing growth. If you're chasing growth, you shouldn't be here.
I'll illustrate here in a hot minute. JEPQ is my favorite. It yields around 9%. It has a monthly variable dividend, but the dividend doesn't really deviate too much from around 9%. So some months you'll have 43, some months you'll have 41, some months you'll have 39, some months you'll have 47. So you're around that area. So you have like a somewhat reliable income coming in. Year to date, it's up 10.1%, and it's up 33.02% for 1 year. And since its inception in May of 2022, it has an annualized returns of 16.33%. So when I say I like JEPQ, it's literally you just buy your shares, turn your drip on, and you just let it. That's a set it, forget it type thing. You don't have to worry about it. And the reason that I like the closed-ended funds, JEPQ has like NVIDIA, it has Tesla, it has Apple, it has Microsoft in it. So you don't have to worry about buying the individual stocks. You're getting a fund that's paying you 9%.
Yeah, I was going to say the individual tech stocks don't pay crap for dividends.
That's one that I like. In the tech sector, there is NBXG, which is pretty much similar to JEPQ when it comes to holdings. It yields 10.3%, so you get a higher yield, but it has this one is consistent. It's 10% or 10 cents monthly per share. That has went up, I think, once in like the last 2 years. So like even if it goes up, it's going to go up to 11 cents. Or if they cut it, it's going to go down to 9 cents. So it's going to be around that 10 cents per month. It's only up 8.33% year to date and 20.67% for 1 year. But since its inception in May of 2021, it's down negative 3.67 annualized per year. It hasn't recovered from the sell-off in 2022. Remember 2022 was a year. Everything went crazy. It went down, but it's working its way back up. We've actually had this one for a while now, and we're up 36% with a 15% share increase. What that means is we actually have increased our share amount by 15% in the year we've had. I forgot to mention JEPQ. We've had that one since September of 2022, and we're up 34% with the 26% share increase. So you see, like with those two, with the set and forget it technique, you're accumulating more shares, thus increasing your monthly income because they're monthly dividend payers. And it's pretty fucking sick, actually. I like it. And my third fund for technology is HRZN. This one's a little bit different. They will invest in startup companies that are nearing their public
IPO?
rollout. Yeah, something like that. IPO rollout. They have an 11% yield, and they pay 11 cents monthly. Only has a 7.7 PE, and its peers have an average of 20.04, so it's a little bit undervalued compared to its peers. It's down 11% year to date, but it's only down 1% for 1 year. This is one that's been affected vastly with interest rates. When the Fed actually lowers the interest rate, this one will recoup most of its losses, and I like it. It's kind of like Hercules Capital in that it has a niche that it invests in. It's tech companies that are going public soon, whereas Hercules does the same thing with like healthcare and tech.
Well, while we're on the interest rate topic, update them on what you just saw come out with those jobs reports and everything.
Okay, Wednesday, the job report came out, and the job report was really low. They were expecting like 200 some thousand new jobs, and it was only 175,000 new jobs. That's why the market went just ballistic the end part of this week, is because people are starting to see the economy soften because the unemployment rate went up a little bit. There's less jobs, and wage growth was lower than they anticipated, so that the experts are starting to think that there will be an interest rate cut in 2024.
I was going to say, so on the surface, that looks like a bad thing. But if you understand how the interest rate changes work, they don't want to lower interest rates preemptively, but they'll lower interest rates when they start getting signals that it might actually compromise the economy. And that's what's starting to happen with those metrics coming in.
Well, if you think about how inflation works, the whole reason that interest rates have been held steady is because inflation is not going down as quickly as possible. If everybody has a job, and everybody has a job that's paying really good wages, then there's no incentive for prices to go down.
Yeah.
It's only when there's less people with money that they'll start dropping prices. So
and that's because they don't want to push things into an actual recession. So it's that delicate balance they have to walk. So those numbers are actually really good from the perspective of the interest rates actually coming down like they suggested before. Hopefully those numbers stay consistent so that does happen, because when it does happen, if you get into some of these stocks that we're going to talk, because a bunch of the other ones coming up have the interest rate problem too.
Right.
If you get into these before this interest rate actually gets cut, ooh, baby, they are going to be like popping off.
You'll have a lot of price appreciation, and then you'll have a different problem entirely. It's like when to turn your drip off and when to take your profits. That's a completely different monster that I'll address once interest rates look like they're going to go down.
Once things change, we'll do a dedicated episode on that.
Back to HRZN. We picked this up in September of 2022. We are break even, but we've had a 25% share increase. That means instead of $55 a month, we are now at $69 a month, which is a difference of about $150 a year.
Woot woot.
So that's just drip working. That's why they always...
The magic of drip.
All the people always talk about compounding. Like,
yeah, compounding is the truth.
Like we mentioned previously in a podcast, like when the market goes sideways, that's like a perfect storm for people that rely on drip. It's ideal for
dividend investors. It's ideal.
Because you don't have to worry about turning your drip on and off. You just leave your drip on. You're accumulating shares at a reasonable price, and you're just piling up shares every month or every quarter.
An increase in your earnings.
Yeah. So that's the three funds that I would like for a starter portfolio. The one that I would pick
in the tech sector.
In the tech sector would be JEPQ. It might be a little high price. I think it's like $40-some. But if you want to go with the lower price, you can go with HRZN. But one of those three would be a good start for your tech sector of your starter portfolio.
And when we say start, we're saying like you have a capped amount of money. So you're going to want to divvy it up. So pick one in tech and one in each of the sectors coming up until you get all those covered.
I'll explain at the end how I would do this.
Yeah, okay.
The next sector I will address will be utility. And utility is like... I think it's misunderstood because people think utility, they think like power, water, but there are a lot of other things that qualify as utility when it comes to experts. Telecommunications is one.
Yeah, I found it kind of interesting that certain things are considered utilities that the average person would not, which is cool because...
Like Verizon's the first one on my list. Verizon's technically a utility stock. It has a 6.7% yield and a 67-cent quarterly dividend. It has 19 consecutive years of dividend growth, which is what you want to look for as an income investor. You want to find income stocks that are raising their dividend when it comes to individual stocks. Like with funds, you're like they'll cut them, they'll raise them. They're sometimes variable. But when you're looking at individual stocks, you want a stock that will raise its dividend every year. That's sick when it happens like that. Verizon's PE is 8.6, while its peers have an average of 18.65. So it's undervalued. It's up 4.7% year to date, and it's up 5.8 for 1 year. We bought this in 2023. I remember beating the table on the podcast saying Verizon. We're up 26%, and we've only had a 2% share increase because we've only collected one dividend. We're about ready to collect the second dividend, so that'll be up to about 3 to 3.5% share increase.
So that's pretty funny that we have a 26% value increase with only one dividend payout.
If you remember, though, I said
that was the thing we said. Those tables.
Verizon is severely mispriced. It's undervalued.
People went into panic mode and were too scared to buy
it was trading at like $18, $19 a share when it should have been like really $40 a share. So
that is really cheap.
The second utility stock is BKH. That's Black Hills something other.
Holdings. It
has a 4.8% yield, 65% quarterly dividend. It's grown its dividend 54 consecutive years. And it sports a 13.9 PE, while its peers have an average of 16.3, so it's slightly undervalued still. It's only up 1% year to date, but it's down 16.66 for 1 year, so that would make me think that might be a time to get into it, and we did get into it when I saw that was like that. We got into BKH in January. We're only up 1.75, and we've only collected one dividend for a 1.7 share increase.
Really? We haven't held that one that long.
Well, we've only got one dividend. I really like that one just because it has 54 years of dividend growth. And like once you get beyond like 25 years of dividend growth, like their primary focus is shareholder
dividend.
Give that.
Keeping the dividend
buybacks and dividend increase. And then the third one on my list is one that I remember beating the table about a few times.
Oh, yeah.
NEP, which is, if you're familiar with the utility sector, NEE is like the main utility in Florida. NEP is their alternative energy offshoot. It's like their wind and solar. It has a 12.23% yield, and it pays an 88-cent quarterly dividend. Its dividend is getting ready to go ex-dividend, I think, this week. It has 10 years of dividend growth, 15.5 PE, and its peers have an average of 17.94. It's down 2.6, and it's down 54% for 1 year. And I remember when we discussed this, there was a huge sell-off because it said it's not going to grow its dividends at the rate that they said they were. It's going to grow it a little bit smaller, and people panicked because they thought that meant like their EPS wasn't going to grow at that, earnings per share wasn't going to grow at the rate, and it was literally just their dividend growth projections, which were in the 6 to 10% range instead of the 12 to 15% range. So we're talking like no reason for panic selling
whatsoever.
So we bought this in October of 2023. When I saw all this, we're up 32%, and we've had increased our share.
Quantity of shares.
Our share increase was increased by 7%. If you don't feel comfortable buying individual stocks, there are a couple of utility funds out there. The one that I like the best is UTF. It's a utility and infrastructure. So I like that they have infrastructure as well. It yields 8.25%. And it has a monthly dividend of 16 cents. It's up 9% year to date, 5% for 1 year, and it has annualized returns of 9.3 since 2004 when it first came out. So if you don't, like I said, if you don't feel comfortable buying one of the three stocks I recommended, then pour your money into UTF. And as a starter portfolio, I would suggest getting into UTF before buying one of the other stocks.
Really? Yeah. Even though you like the individuals better for utilities?
I love the individual stocks better for utilities, but because they're only going to have a certain amount of funds to put forward, the best bang for the buck is going to be getting into the closed-ended funds UTF.
All right, so there you got it.
The bonds one, I know I beat the table on bonds repeatedly over and over and over and over and over and over.
And then they popped off, and then we said don't buy.
Don't buy, but there are a couple of funds that are pretty nice when it comes to bonds. One of them is PDI. PDI I really like.
PDI is my fave.
It has a 14% yield, and it gives you 22 cents a month every month in dividends. It is up 4% year to date, and it has a annualized return of 11% since its inception in May of 2012. We bought this in November, and it's up 13%. We've increased our shares 6%. I really like PDI. If you know anything about like the management companies, the PEMCO is like one of the best management companies when it comes to funds. And then we have the next two as well. YYY is the second one I like here. It has a 12% yield with 12-cent a month dividend. It's only up 7.8 since its inception in June of 2012. We bought this in July of 2023. We're up 11% with a share increase of 9%. It's good, but it's not as good as PDI. But it's, I think, a little bit cheaper than PDI, if I remember correctly. And the third one's DSU. It has a 10.5% yield, and it gives you 10 cents a month dividend. It has annualized returns of 6.5 since its inception in March of 1998. And again, we bought this one in July of 2023. We're up 18% with a share increase of 7.4. So like, if you go through this, like the one that we are accumulating the most shares in is DSU. The one that we are up the most in is DSU. But the one that I like the best is PDI. I just like their allocation of bonds better than DSU. But
Ooh. Tell them about the bond that you woke up the other day and were like, what? What just happened?
We had a bond, and it was a Laredo bond that wasn't supposed to be called for another 5 years, and they called it back. And they called it back when it was trading at 105.6 or something like that. So if you remember when we discussed bonds, when they call a bond back, they call it back at par value, which is 100. So we lost that 5.2 or 5.6, whatever it was, profit. But when they call it back, they do give you the interest that they owe you.
And that right there, again, is why you do not buy bonds above the 100. And if you can buy it even further below par, you have that buffer space in.
So like when we discuss preferreds and we discuss bonds and we discuss CDs, you never want to buy those above the par value, which will be 100.
I think you said for that one you bought it at 98, right?
Not at 98, but we had it for 3 years, so we collected a lot of interest on it because it was a 10.1%.
It does still suck that we lost that 5%, but
yeah, when they bought it back, we're still up 39% because we got it at a decent price and we collected all the interest through the years. So it wasn't the end of the world, but it was like, I had to figure out what the hell to do with all this money because we had a lot of money tied up in it.
He was like, "What am I supposed to do with this money now?"
It was horrible.
He wasn't expecting it, but that's what can happen 5 years early. That's just FYI on the bond thing.
Okay, so the third sector that you need to have in an income portfolio is energy. Energy is not going anywhere. As much as they want energy to be the solar and wind, no, energy, like there's going to be oil. Just how it is, oil and coal. The first one on my list is ARLP. I remember we sent a blast out about this one because something happened where like they were selling the shares off. And I said, whoa, don't sell, actually buy. ARLP, it has a 13.2% yield. And it's paying you 70 cents a quarter per share in dividends. It's up 225% for 3 years, and it has a 4.4 PE, while its peers have an average of 4.5. So it literally is fair value. But if you look at the energy sector, when you have a 13% dividend at fair value, that's a no-brainer.
Yeah.
We bought this in July. Again, in July of 2023 seems to be when I did most of my good stock picking. We're up 21%, but we've increased our shares by 10.4%. In not even a year, we've got 10% extra
I'm assuming
shares.
A lot of that gain came from that dip we talk about buying, right? Pick up the dip.
I only put a couple $100 into it because we got it at such a really good price the first time.
Plus, we might have had a cash flow problem.
So, like, that's why when you're looking at things to buy, you never want to. If the PE is popping off and it's higher than its peers, you don't want to buy it no matter how much you want it. You don't buy it because there's always panic selling and there's always factors that you can't foresee that are going to cause problems. And then what happened in that case, it went down by like 12% within like 3 days. And a lot of people were shitting their pants because they're like, oh my God, ARLP is going off. So do I sell? And like, if you went on Reddit, there was like a threads about, do I sell? Do I sell? Do I sell? And if you read like the publications and emails, everyone's like panicking. I like what they do. They're a coal company. They're the number 2 coal company in America. They're not going anywhere. So like when I see that their PE dropped at that time, it was like 3.2. So that's, to me, means buy. It doesn't mean sell. Now, if it's another company like, I don't know, Joe Schmo coal company that's like the 100th best one in the country, then okay, maybe you have a problem. But because they're the second biggest.
Well, I was going to say people panic sell all the time. And if it's not right priced when you want to get in it, just wait a quarter. There's quarterly reports that come out all the time and people misinterpret metrics left and right and panic sell. And then 2 weeks later, they're like, oh, that wasn't a bad buy. And then they get back in after they lost their freaking profit.
That's why when we discussed things previously, I said you want to have a portion of your portfolio in bullet shares. And the reason you want that is specifically for when there's a panic sell in something that's a good company that's undervalued, you can sell your bullet shares like that, as opposed to a CD. You have to wait a couple days, and so you sell your bullet shares. So you can
hop on the ones that are on your wait list.
And then you can pick them up right away.
Yeah.
My second energy company is ExxonMobil, XOM. It only has a 3.14% yield, which is 95 cents quarterly per share, but it has 41 years of dividend increases, consecutive years. It's up a lot year to date, 20% year to date, 116% for 3 years. It's overvalued according to, this is one of those weird ones. It's overvalued compared to its peers. It's 12.98 PE, while its peers have an average of 11.02. The reason I got into it, we got into it in December of 2003, and we're up 17%, but we've only had 1.6% share increase. I'm never selling this one. I overpaid, but I was willing to overpay for a company that I know is going to give me a dividend increase every year. I overpaid by $1 or $2. Like, it trades at like $100. So I could have waited till it went down to like 89 or 88, something like that. But I bought it at like 98. So that one you have to hold on. Like, if you're thinking about getting the ExxonMobil, I would hold on.
That's like a 30-year play.
Yeah, that one, if you get into it, you're never getting rid of it type thing. The third one's a micro cap one. It's probably the best small cap energy stock that I found in my research. It's called KRP. KRP has a 10.5% yield, and it gives you 43 cents a quarter in dividends per share. It's up 6% per year for a year to date, and it's up 57% over 3 years. This one is overpriced as well. Energy is going to be overpriced for a couple of years. So, like, you might want to actually not invest in energy until the PEs come down. But the PE for KRP is 18.1, and its peers have an 11.02 PE, which means it's way overpriced. But we bought this one in September of 2023. We're up 7% with a 7% share increase. So in energy, if you really need to get into energy, get into ARLP, because it's the one that, according to the value metrics, is the best right now. Like, its PE is like it's fair valued. If you don't, then you might want to get into an energy closed-ended fund, or you just want to hold in bullet shares.
And wait.
But all three, these are three of the best energy plays.
But like you said, with ARLP, it pays 13% dividend. So it's kind of, to me,
but if you see the difference, PE. ARLP pays a 13% yield, and it's trading. It's sideways, a fair value. Yeah. I recommended that one over KRP, which is 10.5% yield, but it's overpriced,
by a lot.
Overvalued by like 30%. Mm-hmm. So the 10.5% yield is not going to mean if it drops the 30% back to the regular PE value.
Yep.
So energy is a tough one right now, but you should have energy in your portfolio. So I'm trying to think of like an energy fund. I mean, they have like they have like AMZA is a decent one for an MLP. Like, it's a collection of all the MLPs. But I would just put money into bullet shares and wait for the energy prices to come down. They always do. Now, we're in the fourth sector. The fourth sector is REITs, REITs. We've discussed these previously. There's a lot going on in the world of REITs that's not positive because of interest rates. Like the share prices keep dropping, and like there's a lot of ones are cutting their dividends. I have two listed here. IIPR is an absolute banger. I don't know if you're going to be able to get into this one at a reasonable price, because when I did the research for this was like 2 weeks ago, and since then they've actually said they're going to move marijuana possession down in the court system, where it's just a misdemeanor anymore. It's not a felony. So they're on their way to legalizing marijuana. What IIPR does is it literally rents out warehouses and land to pot farmers.
So this one's popping off?
It popped off. It went up probably 18% in the last week.
Wow, that's a big climb.
It yields 7.3%, so that probably came down to like 6.5, 6.7% range. But it does have a $1.82 per share quarterly dividend. At the time that I did this, it had a PE of 16.65, while its peers had an average of 30.9, so it very well could still be undervalued compared to its peers. But it only has a 6-year dividend growth streak, but its annualized growth rate is 17%, means that when it hikes its dividend a lot. And it's been doing it like the last 6 years. It's like a lot of the companies, like ExxonMobil, for example, hike it like 3 or 4 cents, whereas IIPR is hiking it like 25, 30 cents a share. So like they hike it a lot. We bought this in December of 2023, and we're up At the time I did this, again, it's up more than that. I think we're like 11% now. It was 3% with a 4% share increase. But I like that one a lot, specifically because I fully anticipate marijuana being just like aspirin in the near future. Mm-hmm. And the reason that the marijuana stocks have been depressed through the years is because they were still technically against the law.
Yeah.
So that's one to watch because it's only going to go up. It's trading at like 112 or something like that now.
I would recheck the PE to peers, see if it's undervalued. If it's undervalued, throw some money at it. If not, put money in bullet shares and wait for some bad
if not,
news.
like the one that I actually recommend of the two is ABR. ABR I know is undervalued. ABR is one that I've talked about a lot. This is the one that plants trees. So every time you buy something from them, they plant a tree. Every time you get a loan, they plant a tree. Like, they're pretty cool. I like the fact that they try to make the environment better. They're yielding 13.21%, and they give you 43 cents a quarter per share in dividends. Its PE is 7.8, while its peers have an average of 15.09, so it's a lot more undervalued. Like, there's no question on this one compared to IIPR, which is, who knows, right now. It has a 13-year dividend growth streak, and it has an annualized growth rate of 6%. And they actually will sprinkle in special or extra dividends probably once a year. They'll actually give you like a 10 cents, 25 cents, whatever extra in dividends. We've held this one so many times through the years I've lost track. But the last time we actually sold it and bought into it was May of 2023. And we're up 21% with a share increase of 8.5. ABR is one that you will accumulate shares quick because it's trading at $13 or $12, whatever it is. So you put a couple $1,000s into it, you get a bunch of shares, and then because it gives you a pretty decent yield of 13% every quarter, plus the possibility of special dividend, you accumulate. Like, we've went up. I want to say we've probably went up 60 or 70 shares in the time we've held it. We've only held it for a year.
That's a lot. That is a freaking crap ton.
So when it comes to REITs, ABR is the one I'd recommend. But if you have extra money, say from the energy one, and you don't know what to do with it, you could dump it into IIPR if the value metrics
if the PE's in the right spot,
or in the right spot. Yeah. The fifth sector is BDCs, and like, if you own an income investing portfolio, the cat is freaking the hell out. If you own an income investing portfolio, you have to have BDCs. It's like a rule. I don't make the rules; I just follow them because they yield the most. And it's very easy to find undervalued BDCs. Like, you'll see how much they yield here in a hot minute.
Yeah, and the reason is because of the interest rates, right?
Yes. Like, I will, like, right now.
I said, like, 3 of these sectors are all depressed because of interest rates.
Right now, I'm like, the BDCs, I'm going to, like, there's more out there that yield like Trinity's 13%, TRIN's 13%, OSCL is like 16%. So you'll find ones out there that have much higher yields than the 3 that I have here to recommend. But at the same time, these are the absolute 3 best of the BDCs. The first one's Hercules Capital. We've discussed this one ad nauseum.
Love it.
It has an 8.4% yield, 48 cents per share quarterly. It's grown its dividend for only 5 years, but it's raised its dividend 12 times in the past 5 years. So had they been like the other companies that are worried about their dividend growth streak, they would have just raised it 12 years instead of doing it 12 times in 5 years. Its annualized growth rate is 6%. Again, that's a really high annualized growth rate. That means if you hold the stock for 5 years, you're getting 30% in dividend growth. Year to date, Hercules is up 13%, and it's up 45% for 1 year. It's vastly undervalued. It has an 8.3 PE, while its peers have an average of 20.13. This is probably one of our longest holdings currently because of the buying and selling I've done through the years. We've had this since July of 2022, and we're up 50%, and we've had a share increase of 21%. I beat the table about this one all the time. It's the one that, like, they invest in the end, like, before things go public. It's like a venture capital company. Before the companies go public, they invest in healthcare and technology. They do. They're kind of similar to what HRZN does. The absolute best one, though, of the BDCs is Main Street Capital, MAIN.
Because?
It's raised its dividend for 15 consecutive years. It has special dividends usually twice a year, has a 5% annualized dividend growth rate. This one's just the bomb. Its PE is 9.37. Its peers are 20.13. This is one that if you have an income portfolio, you have to have Main Street Capital in your portfolio. It has only has a 6% yield. Like I said, you can find other BDCs that have much higher yields, but this one is the best. It has a 24 cent per share monthly dividend. We've held this one so many times. Again, we've held this one a lot. The last time we've bought it in bulk was November of 2023, and we're up 15% with a 3% share increase.
In bulk.
Like Main Street and Hercules, and the last one we've had. This last one is one that I've only held once previously. It's ARCC. It is the biggest BDC. So like what I was saying, like, what was I saying when I said like it's the second biggest, or when ARLP is like the biggest, the second biggest coal company in America, ARCC is the biggest BDC in America with market cap value. It has a 9% yield and it pays you 48 cents per share quarterly. It has not cut its dividend in 15 years and has raised it 8 times in 15 years. So it's not really focused on a dividend growth streak like a lot of other companies. Like I guess it's like a badge of honor. Oh, we've raised our dividend for 10 years straight, or we've raised our dividend for 12 years straight. ARCC is more concerned with keeping the balance sheet under wraps. And then when they have extra money, they'll give you a dividend increase. But their primary goal is not cutting the dividend, which is nice in a BDC.
Yep.
If it wasn't for Maine, this would be the one that I'd recommend to everyone, but Main Street Capital is just better. This one has a 7.79 PE. The average of the peers is 20.13.
That's way undervalued.
Well, they're all going to be because of the interest rate crap we have going on. We've held this one since August of 2023, and we're up 12% with a 6% share increase. But if you're starting to see a theme here, like our shares have increased a lot through all these different holdings we have. And that's what I like.
Especially the interest rate ones.
That's why I say these are like the starter portfolio. Like I know there's other ones, like other people out there, other experts say the starter portfolio should be this. Well, I'm actually using data that we have. So I know the price of these. I know when they're undervalued, and I know what the possible rewards are to reap if you buy them at the right valuation, because I've held every one of these. Except for UTF. I never held that fund for the
That's
utilities.
because you prefer individual utilities.
Yeah. Consumer staples. Consumer staples, again, like toilet paper and whatever. Like the best consumer staple company out there is MMM. But
there's some sketchy stuff going on right now.
Things just changed this week with MMM. Prior to this week, 64 years is how long they've had a dividend growth streak of 64 years. They're actually cutting their dividend for the first time in like 65 years.
They're giving up their dividend king status, which is insane if you think about it. And I said they have to have a specific plan to do that.
If you know what happened with them, they spun off. What spun off means is they actually created a different ticker, different company for their healthcare product. Their healthcare was 19% of their revenue. They spun that off into its own company. It's called SOLV. If you got the email, you know we sold all of our shares in that because it wasn't offering a dividend. I have no desire holding something regardless of if it's good or not, if it's not paying me to own it. So we sold that off. So they spun off their healthcare portion. So they got rid of 20% of their revenue. At the same time, they have litigation going on from like the earplugs with the troops and something with PFSA chemicals in the water. So they have billions of dollars in litigation, but the fines are spaced out over the course of 10 years for the earplug one and 20 years for the water one. So the fines won't be that big of an impact on their overall financials, but they're actually cutting their dividend. Their dividend prior to the cut is 6.6, and it's $1.51 a quarterly dividend per share. I don't know what it's going to be when they do it. I'll know more in I think a month when that's going to come out.
Yeah, so the share price of that one dropped pretty significantly.
Actually, the share price went up.
Oh, it went up?
Mm-hmm. Everybody was getting out of the MMM because they thought the dividend wasn't sustainable. So once the management said that, hey, we're going to cut the dividend, the share price shot up by 12%.
Is that why you got out?
I got out. I sold half my position, yeah.
I actually thought you got out because it went down. Mm-mm. That's really funny. I would have took half out too.
Yeah, I sold half. Like we had close to $10,000 in Triple M. I sold half of my position. And if you get the email, you'll see what I did with the proceeds of that. I split it up into equal increments in 3 new investments. But the PE of MMM is 12.2. The average of its peers is 16.37. So like all this data is like past data. So like, but anyway, it's not even the one I recommended of the consumer staples. The one I would recommend is MO. It's the cigarette one. So if you have a problem with cigarettes,
either get over yourself or go find a sustainable thing, AJ.
MO has a 9% yield, so it actually has a better yield than Triple M. It has so it's 98 cents per share quarterly. They've raised their dividend for 54 consecutive years, and they have a 4.5% annualized dividend growth. So that's pretty high for a company that's as developed as MO.
I figure if smokers are going to smoke, you might as well make money off of them.
MO is up 7.5% for year to date, but for 1 year, 3 year, and 5 year is down, and it's down significantly in 3 year and 5 year, like down 15% or something like that. What I found through the years with MO is entry price is everything when it comes to this one. And what I've actually done with this one is anytime the price per share falls below $40, I'll pick up more shares. It has a 8.53 PE, and its peers have a 14.1 PE. When it falls below 40, that PE is actually below 8 PE, so it's like a 7.6, 7.7. So that's why I say when it falls below 40, I pick up additional shares. We held it multiple times through the years. Like we even have a bond in MO. It's the one I've been trying to get out of, but I can't really justify getting out of it. It actually pays like half less. It's a 4.5% bond, so it's paying half less than the actual stock. But we got it at such a good price. We got it at like $62 or something like that.
Holy crap! Below 100? That's insane.
Yeah, so we're up 8. We've had this since January of 2024. Is the most recent time we bought a bulk of MO, and we're up 8% with a 2.4% share increase. MO is the better one. Like there's other ones out there. There's Philip Morris and there's BTI. BTI is the third one I've listed on the consumer staples. The only reason I listed it is because it gives you a 10% yield. So it actually has 1% more than MO. 74 cents per share quarterly. But it has a variable dividend. It means sometimes it's 74 cents, sometimes it's 58 cents, sometimes it's $1. So that's one of those that like if you want consistency in your income portfolio, which retirees do, and if you're using your income to supply your life on the road, which is like what we're going to be doing, that's why we're not in BTI. Her mom's in BTI because it's a retirement account and she's not retired yet. Once she retires, I'll probably transfer from BTI over to MO for her mother because it's not consistent. You want it like whenever you're on an income, you want like it's consistent income. So the MO is better than that. It's cheaper. It's a lot cheaper. Like Altria trades at like $40 a share, whereas BTI is at like $28. It's $12 cheaper, so you can get more shares per dollar.
I would imagine that compounds faster too.
It does, but like the difference between like the returns is something that I pay attention to. MO is down 7% 1 year, 8% 3 year, and 19% 5 year, whereas BTI is down 20% 1 year, 23% 3 year, and 23% 5 year. So it's down more than Altria, like a lot more. And then again, this is when the entry point is going to be crucial when you're investing in BTI. And with her mom's account, anytime BTI falls under $29 a share is when I pick up additional shares. It has a 6.44 PE, so it's vastly cheaper than most of the MO. Yeah, it's vastly cheaper than MO. MO is 8.53.
What's the average up here?
14.12.
Dang, that's less than half.
We've held BTI since November, and we're up only 2% with a 2% share increase. So you can see the difference. Like we've actually held Altria less, and we're up more with a more share increase. So like I think Altria is the better one. That's why I say my recommendation for the consumer goods sector is MO, and then if you have money left over, do Triple M. But then Triple M kind of imploded, and price went up. It's one of those weird things like where it's all bad.
Do you think it's going to crash later though? I was going to ask about that.
I think it will crash whenever they come out with a dividend. I think people are super stoked because like, oh, they're cutting the dividends. They're like the dividend's going to be better sustainability with the dividend. But once they see what they're going to cut it to, like my prediction is, and I'm not like a forecaster, but I think it'll probably be, they're going to take it from, what was it? It was $1.51 quarterly. I think it's going to be under 75 cents. I think they're going to cut it like more than half. They're going to cut it a lot, and I think people are going to panic and be like, oh my God, they're like, I'm not going to get any money for holding this.
Well, because that's what I was thinking. I was thinking the excitement of the smart business decision is going to overinflate, and then once they actually realize what that signifies for the people holding it long term, it's not going to be good. So I'm hoping you selling half of it, we kind of win either way you look at it, because if it goes up again, we still have our shares. But if it goes down, we can pick up shares at a discounted price.
Well, that was one of the things I was going to address with the income portfolio. Is like we were just discussing what I did with Triple M. Like the news came out from the earnings report, and like that's why I say you have to monitor your account. You can't just like set it and forget it. Like I'll tell you if it's set it and forget it. Like PDI is a set it and forget it. JEPQ is a set it and forget it, because they they're ETFs and they're closed-ended funds that have access to so many companies. So it doesn't matter if one of the company does something that's sketchy or like they do something that's bad news. If you're owning individual stocks, you actually have to monitor them. Like as soon as I saw that the dividend cut came, I was like, okay, let me see what's going to happen. And when I saw that everyone was euphoric about it, I was like, well, that's not good. So then I sold half the shares. I might actually sell all the shares if it keeps going up in price, because I know what they're going to do. Like they said that they want their dividend to be under 50% of their revenue. And that if you run the numbers, we're talking 40 or 50 cents a share.
Oh, yeah, that's going to be a big death blow later. Wow. All right. Yeah, I'm curious to see what happens.
But the reason I like Triple M is because if you remember when we were discussing economic moats, they have the best economic moat. So it's one of those that I might sell everything now and then wait for it to implode and then buy it back later. If you look at the experts, they're saying that like their predicted price is like $70 a share, and it's currently like $100 a share. Like only one person thinks it's going to trade for more than it does now in a year. The rest of them are like $60, $70, $78, $82. So they all know it's going to fall by like 20%. So the people buying into it now are insane. That's why I was like, well, I'll sell you shares. Here you go.
I'll sell you my shares.
Have some. Yeah. So you have to monitor, like when you, like I said, I'll reiterate, if you own individual stocks, you have to pay attention to in earnings reports.
Yep. Earnings reports in the news.
So, in summary, the starter portfolio should look like this: JEPQ, UTF, PDI, ARLP, ABR, Main Street Capital, and MO. What I do is I'd begin a position in each of these, say whatever you can afford. Like my example was $2,000 to $5,000 in each one of them. So that would be 1, 2, 3, 4, 5, 6, 7. So you're
do it as a percent of the portfolio. There's 7 of them?
There's 7 of them. So I would just do it. I'd put 1,000 into JEPQ, and then the next time I could put 1,000, I'd put 1,000 into UTF, and then I put 1,000 into PTI, and I'd keep doing that until I established a pretty good chunk of change in each one of those before I started branching out to the other ones that I listed. So if you disperse your money equally, your portfolio is going to yield what?
10.37.
10.37. And if you do the stocks that I recommended, so you're going to be getting 10% plus 1, 2, 3. 3 of those are dividend growers. Oh, 4 of them are dividend. The 3 of them are dividend growers. ARP is not. It's a variable one, but it's pretty good. And then you're going to have 3 consistent funds that pay you X amount per month in JEPQ, UTF, and PDI. So you have a lot of stability, and you have a lot of consistency with your income portfolio with those 7 different investments. And then you can, like I said, branch out. Once you get that up to a certain point, you can branch out into if you want different sectors. Say you want, I don't know, fast food, or you want whatever. Like you can then branch out into different sectors. But your starter portfolio should be ideally like at least 40 to 50% of your overall portfolio when it's all said and done. Because Hercules Capital and ARCC are really good companies. So that would be the first one. I would put my money into Maine, then I'd get all the other ones up to a decent amount. Then I'd go Hercules Capital and ARCC, Ares Capital. And then I would go from MO to Triple M and then to BTI. Then I'd go for Arbor to IIPR. If you go on the website, it's all written out.
I'll put the link to the blog post in the show notes. That way you can actually walk through these and look at it when you're not multitasking.
Yeah, so that's my starter portfolio. It's awesome. We hold every one of them except UTF. So I'm pretty knowledgeable about every one of the investments I brought up today. I'm pretty knowledgeable about. UTF, I've been recommended multiple times. If you remember when I did the sources of the Contrarian Outlook, he brings that up all the time. UTF, and then UTG. Like it's all the time.
But again, it's like PDI. So if you do like the fund thing where you don't have to keep up with the news and everything, go ahead and throw it in that versus the individual utilities.
And they for example, the energy. I know they have energy funds that cover all of them. They'll have an MLP that'll cover all the different energy ones. They'll have an energy fund that covers all the different gas companies or all the different the midstream companies. And I know for REITs, they have like a REIT of a fund that has all the REITs in it. And I know for BDCs, they have another one that's like all BDCs. Like it'll have shares in Maine, it'll have shares in Hercules Capital, and shares in ARCC. But for some of them, I like funds. For some of them, I like the individual investments. And I'd rather have Maine than a fund that holds like 6% in Maine.
Okay.
If you have any questions or comments, reach out. I'll help you out. Like, email me. So
my question is, how long does this thing stay valid for? Like, what's the longevity from post-date?
Forever.
Forever.
Literally,
you recommend these stocks forever?
I do.
Okay. That was
the only thing that I would differ
so
would
this
be...
is the evergreen portfolio.
The only thing that's different is I would turn the drip on and off depending on PE valuation.
Okay.
Like, I'm telling you, like, these are like the cream of the crop. That's why I like...
Creme de la creme. Okay, so this is the evergreen portfolio.
Only one that's in question would be Triple M, and like we'll know more about that whenever they announce their dividend cut, like in a month or two.
So I would say if this is evergreen portfolio, these are all stocks to put on the watch list, and then you just have to pay attention to the PE versus peers. And obviously any like crazy news.
Well, the financials, you have to make sure they're not accruing a lot of debt and like their revenue.
But I'm just saying, like if this is the evergreen portfolio.
But yeah, like we hold all these, and like we hold all the ones I brought up, and we'll probably hold all the ones we brought up for years and years and years and years.
And if we change that, you will find out on the recent episode of the podcast.
Yep. If I go all like, oh, I had to sell Hercules, I'll like for sure mention it, but I highly doubt it. All
right, guys. So get started with what was the one you said? ARLP?
No, ARLP, no, I would start with JEPQ or NBXG or HRZN. That's where I'd start with the tech one because tech's going to be the thing of the future. So I would like literally start at the top. Like how I have them listed is how I'd start. Okay. I'd start with JEPQ. Then I would start with the UTF.
I'll actually add a sentence in there for that. So get your take home today is to throw some money in the first one. If you got more money than that, then equally disperse.
Like on the sidebar, I'm so proud her mom finally opened up a Worthy account.
Oh my God, I know! We're in the process right now because she has one of those stupid federal credit unions who doesn't have Plaid, so she can't instantaneously open and transfer banks. We have to do those stupid micro deposits. So as soon as that happens, she's throwing 10 grand in there and she's going to watch like the $2 a day compounding.
So obviously you want to have your emergency fund in place before you start your starter portfolio.
And guess where that money came from, guys? Tax return.
Yeah. And she
it's way better than whatever the heck other people spend it on.
She did listen in that regard.
I know. I'm so proud of her. You have no idea.
Did you make her listen or did she bring it up?
I brought it up to her a couple weeks ago and she actually asked me about it when I was over there last night. I was like, wow.
Like that to me, that is the biggest opportunity for investment there is. It's a tax return that you don't actually have like money accounted for. So like...
Well, actually, how it happened was my dad said to put it in a CD. And when she looked at the interest rates of the CD, she's like, I think Carm said something about this other thing being a higher thing. So she asked me about it again. And I was like, yeah, CDs are stupid.
They're not stupid. You can do like short-term ones, like do 8-month CDs.
Yeah. Trash interest. I'm just saying.
But like liquidity-wise, the Worthy is better.
Trash.
And it pays you 7%. There's a couple other ones out there that are paying more. So... Again, set up your emergency fund with Worthy and I guess if you do SoFi, they actually have a 4.6 check or savings.
Or find your other high yield savings account or do bullet shares. Whatever you want to do.
Like you have before you do your starter portfolio, you must have an emergency fund.
Absolutely.
Because you don't want to like if you notice in all of those, only when I sold off was Triple M and that was extenuating circumstances. Other than that, I just letting shares compound.
Yeah, you'll never, ever hear us saying we had to share sales because we need money for some emergency that cropped up. We will never say that. And if we ever do, call us out on it.
I'll stop podcasting at that point. I'm like, I'm done.
I violated my core principle.
I retire.
All right, so for next week's episode.
Next week's going to suck. This year's just been a shit show. Next week's going to be data on like, because my parents both died like in the last month. And they were young, so I'm going to go into detail about how, like, there's a certain portion of the population that doesn't live as long as people think they're going to live. If you recall, we did a longevity one where, like, a certain portion of the population lives well beyond.
Like his grandmother and grandfather.
We're, like, well beyond what the average is, so you have to prepare for that. But then there's a certain portion of the population that doesn't make it to the retirement age, and you have to prepare for that. So we're going to go into detail about that. It's going to be... I mean, no, I wasn't close to my parents, but it's more, what is that, mortality slapped me in the face?
Yeah. So he wasn't close to him because of his bad childhood and the abuse he went through, but he at least reflected on the fact that he still has the genetic component, and they both died at 68, 69, 67, 68. So
they were young.
That's only 2-3 years in retirement at the normal 65. Like that's...
So we're going to go into detail about the other end of the retirement thing, like what happens, so how do you prepare for if you don't make it to 60 or 78 or 72, whatever the hell the number is. I forget. It's going to be interesting. I think it's pretty cool. It's a topic that I've never heard anyone address. Like I've actually heard the longevity aspect, but I've never actually heard anyone address like what prepare for dying before you retire.
Before you expect.
So
basically live now. All right, so we'll see you guys in next week's episode.
Sorry this is so long.
Hopefully that starter portfolio helps you get rolling. Have a great week.
Yeah.